Okay, let's dive into something that often feels, well, like navigating a dense legal forest. The whole world of income tax authorities.
Mm.
Maybe you're prepping for an exam, or perhaps you just want to really understand the system you operate within. Our mission today is to give you a really comprehensive, exam-oriented breakdown of this absolutely crucial topic.
Right.
We're going to pull every essential concept and nuanced detail directly from your source material. We're talking clarity, depth, and practical application, specifically geared to help you ace those tricky application-based exam questions.
That's exactly right. We'll meticulously navigate the hierarchy, the various powers, and the precise procedures of these income tax authorities. Our focus isn't just on memorizing provisions, like textbook style. It's about linking them to their real-world implications. That's really where those tough application questions often come from.
Oh,
While this chapter might not always be the heaviest in terms of, say, direct marks on its own, it really underpins so much of your understanding, especially for assessment procedures. So we'll make sure you grasp not just what the rules are, but why they exist, giving you a robust framework for, well, any challenge that comes your way.
got it. So let's start by laying the foundational groundwork. Who are these authorities and how are they structured? Think of it like mapping out the entire command chain in the tax world, right?
Mhm.
Understanding the various branches before you dig into how they actually operate.
What's quite fascinating here is how thoughtfully the structure mirrors a conventional, large organization.
Yeah.
It has really clear reporting lines. Understanding this hierarchy isn't just some academic exercise. It's truly foundational for knowing who can authorize a specific action, who is accountable for what, and critically, who an appeal goes to if you, say, have a dispute.
Right.
The Income Tax Act, the 1961 Act, it meticulously defines these classes of authorities. It makes the entire system quite transparent from the highest policymaking body right down to the field officers.
Okay, so at the very peak of this pyramid, we have the Central Board of Direct Taxes, or CBDT.
Mm-hmm.
It's a statutory body, which means it's created and given its authority directly by an act of Parliament, specifically the Central Board of Revenue Act, 1963. And it operates under the watchful eye of the Ministry of Finance.
Yep.
Now, the CBDT isn't just a figurehead, right? It's the absolute highest executive authority in the direct tax world. It controls and supervises every other officer within the income tax department. And very significantly, it's the body empowered to frame the rules for the proper administration of the Act under Section 295. This means they literally write the operational playbook.
Precisely. And from this apex, the entire structure sort of branches out into two distinct operational wings, each with its own specialized function. Think of them as maybe two specialized arms of the same body. Each is indispensable. First, you have the assessment wing. As the name suggests, this wing is primarily concerned with the core functions: assessing income, collecting revenue, ensuring compliance on a regular basis. This wing includes Principal Chief Commissioners of Income Tax, PCCIT, Chief Commissioners of Income Tax, CCIT, Principal Commissioners, PCIT, Commissioners, CIT, and also the Commissioners of Income Tax Appeals, or CITA.
Got it. And then we have the investigation wing. This one sounds a bit more, well, intense.
It is, yeah. This wing is more focused on uncovering undisclosed income and enforcing compliance through specialized operations. It often involves intelligence gathering and enforcement actions. Its hierarchy largely mirrors the assessment wing, but with a distinct nomenclature. This is something you'll definitely want to remember for your exams.
Okay, like different titles.
Exactly. So instead of chief commissioner, you'll find director general. Instead of commissioner, it's director. So that means you have principal directors general, PDG, directors general DG, principal directors PD, and directors D. It's important to note this difference, especially when we later discuss powers like, say, provisional attachment or authorizing searches, which predominantly fall under the investigation wing's purview.
Hey, that makes sense. Keep the labels straight.
Below these higher echelons, common to both wings, you'll find the lower ranks. These are often the frontline officers directly interacting with taxpayers. These include additional commissioners or directors, add CIT, DIT, joint commissioners or directors, JCIP, DIT, deputy commissioners or directors, DCIT, DIT, assistant commissioners or directors, as a CITAT, and finally the income tax officers, ITOs. These are the individuals often designated as assessing officers, or AOs, and they're responsible for conducting those initial assessments. Additionally, the Act also recognizes tax recovery officers, TROs, who handle the collection of tax arrears, and inspectors of income tax who assist in various field operations. That pretty much completes this comprehensive and yet quite intricate structure.
So, with this elaborate hierarchy in mind,
Mm.
how did these authorities actually get into their positions, and how is their work managed day to day? We're talking about their appointment and control, right? Sections 117 and 118.
Mm-hmm.
This might sound like dry administrative stuff, but it's crucial for understanding the legitimacy and operational flow of the entire tax system.
Mm-hmm.
For your exam, knowing who appoints whom helps clarify lines of authority and delegation.
It absolutely is crucial. Section 117 vests the primary power of appointment in the central government. It allows them to appoint any suitable person as an income tax authority. However, to maintain operational agility and avoid administrative bottlenecks, this power is often delegated. The CBDT itself, or even higher-ranking authorities like a principal director general or a chief commissioner, they can appoint income tax authorities below the rank of an assistant or deputy commissioner.
Right.
Think of it as empowering the senior leadership to staff their teams effectively. Furthermore, any income tax authority, if specifically authorized by the CBDT, can appoint the necessary executive or ministerial staff required to assist them in their official functions. This delegation is fundamental to efficient departmental operation.
That makes perfect sense. You couldn't possibly have the central government appointing every single inspector across the country. Now, Section 118 talks about subordination. Once these authorities are appointed, how does the CBDT ensure that everyone knows their place in this elaborate chain of command and that instructions flow correctly?
Well, Section 118 empowers the CBDT to specify, through an official notification, which income tax authorities are subordinate to others. This basically formalizes the reporting structure and ensures absolute clarity regarding who reports to whom and, importantly, whose instructions must be followed. It's essentially the legal framework for that organizational chart we just discussed. It reinforces the discipline and clear lines of accountability essential for the effective and uniform administration of tax laws across the entire nation.
Okay, so the CBDT is at the very top, setting the broad directions.
Mm-hmm.
But how much can it really dictate to the officers on the ground? Here's where it gets particularly interesting for students, I think, because Section 119 outlines the CBDT's power to issue instructions, but also lays down some crucial boundaries. It's not just a free pass to micromanage everything.
Precisely. The CBDT is indeed empowered to issue orders, instructions, and directions for the proper administration of the Act. These are not merely suggestions. They are obligatory for all subordinate authorities and other persons involved in executing the Act. This general power is vital for maintaining uniformity and consistency across the country and applying tax laws. It prevents, arbitrary interpretations or inconsistent treatment of taxpayers. It ensures that tax administration functions as a cohesive unit.
But, and this is a big but, that you'll definitely want to remember. For those application-based questions, there are two critical exceptions where the CBDT absolutely cannot interfere. What are those, and why are they so important for maintaining the integrity of the system?
Yes, these exceptions are paramount. They really highlight the quasi-judicial nature of certain functions within the tax department. First, the CBDT cannot issue instructions that compel an authority to make a particular assessment or dispose of a particular case in a particular manner. This is a fundamental safeguard. It's designed to prevent the executive body from dictating specific outcomes in individual cases, thereby preserving the impartiality and objectivity of the assessment process.
Right.
Second, and equally important, the CBDT cannot interfere with the discretion of the Joint Commissioner Appeals or Commissioner Appeals in their appellate functions.
So the appeals guys are independent.
Exactly. This is crucial. It safeguards the independence of the appellate process, ensuring that taxpayers have an impartial avenue for redressal without executive influence. In essence, while the CBDT sets policy and ensures consistent administration, it cannot dictate the judicial or quasi-judicial decisions in specific individual instances.
So they can set the broad strokes, the general policy, but they absolutely cannot paint the specific picture, especially when it comes to how an assessment is decided or an appeal is handled. That's a crucial distinction for your understanding. Now, let's talk about a more benevolent side of the CBDT's power under Section 119, its ability to relax certain provisions. This sounds like a potential lifeline for taxpayers facing genuine hardship.
It truly is, and it demonstrates the pragmatic and often compassionate aspect of tax administration that, many people don't realize exists. The CBDT can issue general or special orders to relax provisions for the purpose of proper and effective management of assessment and revenue collection. A key condition here, and one to remember, is that such instructions must not be prejudicial to the SSE.
Okay, that's important.
This power covers a broad spectrum of critical areas, including filing deadlines like Section 139, various assessment procedures, Sections 143, 144, 147, 148, for instance, rectifications, Sections 154, 155, interest calculations, a whole bunch here, 2011A, 234A, B, C, E, F, and even penalties like 270A, 271C, etc. This flexibility allows the CBDT to address systemic issues, manage administrative burdens, or provide relief in broad categories of cases where strict adherence might cause undue hardship or be counterproductive to efficient revenue collection.
That's a truly comprehensive list of areas where they can step in. But what about individual cases where someone faces what we call genuine hardship? I'm thinking about situations where, say, someone misses a deadline due to truly unforeseen circumstances, like a sudden medical emergency or a natural disaster. Can the CBDT help there? This is Section 119.2, right? And it feels like a common area for practical questions.
Absolutely. Section 119(2)(b specifically addresses genuine hardship cases. It empowers the CBDT to authorize an income tax authority, and it's important to note, not a joint commissioner appeals, as they handle appellate functions to admit applications or claims after the expiry of the prescribed period. This is particularly relevant for things like claims for exemptions, specific deductions, or refunds. It also crucially applies to the carry forward of losses in cases where returns were filed late. This mechanism provides a vital safety net for taxpayers who, despite their best efforts, genuinely miss a deadline due to circumstances beyond their control.
This is where the practical application really comes in. How does this condonation of delay actually work, especially with those updated monetary limits and timeframes introduced by recent circulars? This is definitely something an exam might test you on.
You're right. The recent Circular Number 11/2024, dated October 1st, 2024, provides pretty comprehensive guidelines for these condonation requests. For condonation of delay in filing returns, particularly those claiming refunds or carry forward of losses, specific monetary limits determine which authority has the power of acceptance or rejection. Think of it as a sliding scale of oversight. For claims up to 1 crore for any assessment year, the principal CIT or CIT can make the decision.
Okay.
If the claim is above 1 crore but up to 3 crores, it goes up to the Chief Commissioner of Income Tax, CCIT.
Right.
And for claims exceeding 3 crores for any assessment year, the Principal Chief Commissioner of Income Tax, PCCIT, has the ultimate authority. This tiered approach ensures appropriate levels of scrutiny and accountability for different claim values.
So the bigger the claim, the higher up the chain it goes for approval. That makes eminent sense. What about the time frame for making these applications, and how quickly should the department process them? Are there strict deadlines for that too?
Yes, there are. For applications filed on or after October 1st, 2024, no condonation application will be entertained beyond 5 years from the end of the relevant assessment year.
5 years. Okay.
It's important to note that for applications filed before that specific date, the period allowed was 6 years. So there's been a slight tightening. This change highlights the department's move towards quicker finality, and once an application is received, the competent authority should, as far as possible, dispose of it within 6 months from the end of the month of application receipt.
6 months turnaround, ideally.
Ideally, yes. There are also specific powers vested with the Commissioner of Income Tax, Central Processing Center, CPC, Bengaluru, for condoning delays specifically related to verifying returns by sending the ITRV form.
Okay, for the ITRV specifically. That's a very useful detail for those preparing. What about situations related to updated returns, which are a newer concept, or refunds resulting from specific court orders? How does condonation work in those contexts?
Good questions. In cases involving updated returns under Section 139A, especially with the recent Finance Act 2024 amendments, the authorities must ensure that the assessee was prevented by a reasonable cause from filing the original return on time, and that it genuinely represents a hardship case on merits. The jurisdictional assessing officer is empowered to make necessary inquiries to satisfy themselves of these conditions.
Right.
For refunds arising from a court order, the period during which court proceedings were pending is specifically ignored when calculating the delay. This is provided the condonation application is filed within 6 months from the date of the court order or the end of the financial year in which the order was issued, whichever is later.
Okay, so the court time doesn't count against you.
Exactly. This provision is absolutely crucial for taxpayers who might otherwise lose out on legitimate refunds due to prolonged litigation.
And what if a taxpayer wants to make a supplementary refund claim? Maybe after an assessment is already completed for that year, but something new comes to light.
Belated supplementary refund claims can be admitted under specific circumstances, provided other conditions are met. These include ensuring that the income in question isn't accessible in another person's hands, that no interest will be admissible on the belated claim itself, and importantly, that the refund arises specifically from excess TDS/TCS, advanced tax payments, or self-assessment tax payments. These conditions are really designed to prevent misuse while offering a practical pathway for legitimate additional claims.
It seems like the CBDT has quite a bit of power to offer flexibility and pragmatism within the tax system. Are there other areas where they can relax requirements, especially concerning deductions?
Yes, under Section 119(2)(c), the CBDT has the power to relax requirements for claiming deductions specified in Chapter 4, Chapter 6A. This applies when the assessee failed to comply due to circumstances genuinely beyond their control, provided the requirements were met before the completion of assessment for that particular year. This is another important relief measure, acknowledging unforeseen impediments to compliance. Every order issued under this specific clause, however, must be laid before both houses of Parliament.
Oh, Parliament gets to see it.
Yes, ensuring transparency and parliamentary oversight over such significant relaxations.
That's fascinating, this blend of strict law and, well, compassionate flexibility.
Right.
It highlights the mutual expectations within the tax ecosystem. Which brings us neatly to the Taxpayers' Charter, outlined in Section 119A. So what does this formal declaration mean, and how does it aim to change the relationship between the department and the taxpayer?
Well, if we connect this to the bigger picture, the Taxpayers' Charter isn't just, window dressing. It's a formal declaration signaling a crucial shift. The tax department is actively trying to foster trust and reduce the adversarial nature of tax collection. It's a formal commitment by the CBDT to ensure fair dealings and a more taxpayer-friendly environment. It explicitly outlines the department's commitments, things like providing fair treatment, treating taxpayers as honest unless there's a strong reason to believe otherwise, offering clear appeal and review mechanisms, providing accurate information, and making timely decisions. It also commits the department to collecting only the correct tax, respecting privacy, maintaining confidentiality, and holding authorities accountable. These are truly core principles of a transparent and just tax system.
And it's a two-way street, right? What are the department's expectations from taxpayers under this charter? Because compliance is, after all, a shared responsibility.
Exactly. The Charter also sets clear expectations for taxpayers. They are expected to be honest and compliant, disclosing full and accurate information and fulfilling their obligations. They should proactively be informed about their compliance duties, maintain accurate records, and understand precisely what their authorized representatives do on their behalf. Crucially, taxpayers are expected to respond to the department's requests in a timely manner and pay their dues promptly. This mutual understanding aims to build a more collaborative and efficient tax environment. It recognizes that a compliant taxpayer is often an informed and respected one, ultimately working to reduce compliance costs for everyone involved.
Makes sense. A code of conduct for both sides.
Precisely. And now that we've established who these authorities are and how they are appointed and guided, let's understand where their powers actually apply. This is the crucial concept of jurisdiction of income tax authorities, covered in sections 120 through 130.
Right.
Without clear jurisdiction, the entire system would, descend into chaos. You'd have authorities stepping on each other's toes and taxpayers facing uncertainty.
You're right. Okay, let's unpack this with Section 120, which covers the general principles of jurisdiction. How does the CBDT actually assign authority to these different officers, ensuring an organized and efficient tax collection system?
Well, Section 121 clarifies that income tax authorities exercise their powers and functions strictly according to directions issued by the CBDT. These directions essentially define the precise scope of their authority, preventing any overreach. When issuing these directions, the CBDT can consider various criteria. These aren't just geographical. They can be based on the specific territorial area an officer covers.
Okay.
The persons or classes of persons they are responsible for, incomes or classes of income, for example. One officer might handle all corporate assessments in a city, while another focuses solely on individuals and even cases or classes of cases. This allows for highly specialized and efficient tax administration.
So it's not just geography. It can be based on the type of income or taxpayer, too. That provides a lot of flexibility. What if a higher-ranking officer needs to step in and exercise the powers of a lower one? Is that permitted?
That's explicitly covered by an explanation to Section 121. A higher-ranking authority can exercise the powers and functions of a lower-ranking one if the CBDT directs them to do so. This is deemed to be a valid direction, providing essential operational flexibility within the hierarchy, especially in situations requiring senior intervention. Furthermore, Section 124 allows the CBDT to authorize principal directors general or principal directors or directors to perform functions of any other income tax authority.
Wow, okay.
This ensures that the highest levels can intervene or delegate as needed for efficient management. This section also specifically allows the CBDT to empower higher authorities like a principal chief commissioner to issue orders for additional commissioners or joint commissioners to act as assessing officers for specified areas or persons, granting them broader administrative control.
That makes perfect sense. It really creates a flexible yet structured system. What about concurrent jurisdiction? Can multiple AOs have authority over the same case or person, and how would that work?
Yes. Section 125 allows the CBDT to assign concurrent powers and functions to two or more assessing officers for a particular area, person, or case. This can be particularly useful for complex investigations requiring collaborative efforts, or perhaps for managing workload peaks. In such situations, if the assessing officers are of different ranks, the lower-ranking authority is expected to act as per the direction of the higher-ranking one. This ensures coordination and avoids conflicting instructions.
Okay, good. Now let's narrow it down to the assessing officers specifically
Yeah.
under Section 124. This is probably the most common authority taxpayers interact with. So who exactly falls under an AO's jurisdiction, and how is that defined for your exam?
Right. An assessing officer, once vested with jurisdiction over a specific area, has authority over two main categories of persons within that area. First, any person carrying on a business or profession within that designated area. If their business operates in multiple places, then the AO has jurisdiction if the principal place of business is within that area. Second, for any other person, meaning not a business or profession, the AO has jurisdiction if that person resides within the designated area. So remember, it's a mix of business location and residential address that primarily determines the AO's reach.
Okay, that clarifies precisely who an AO can assess. But what if a taxpayer genuinely believes their AO doesn't have the correct jurisdiction over their case? Can they challenge it? And if so, who decides that very important question?
This raises a critical procedural safeguard. If a question arises regarding an assessing officer's jurisdiction over a particular person or case, it's not the AO who decides.
Ah, okay.
Instead, it's determined by higher authorities,
Yeah.
specifically the principal director general or director general or the principal chief commissioner or principal commissioner or commissioner. If the question involves areas falling under the jurisdiction of different such higher authorities, they must first try to resolve it by mutual agreement. If they can't reach an agreement, then the CBDT steps in to make the final determination or designates a specific higher authority to do so. This ensures a clear and impartial resolution mechanism for jurisdictional disputes, preventing endless wrangling.
And is there a specific time limit for a taxpayer to raise this question about an AO's jurisdiction? You can't just wait indefinitely and spring it on them later, right? This is a key detail for exams.
Indeed, there are strict time limits, and knowing these is crucial for application questions. If a return of income has already been filed under Section 139(1), you must question the jurisdiction within 1 month from the date you receive a notice under Section 142(1), which is for inquiry before assessment, or Section 143(2) for a scrutiny assessment notice, or by the completion of the assessment, whichever happens earlier.
1 month from the notice or assessment completion, whichever's earlier. Got it.
So as soon as you get that first formal notice, the clock starts ticking for any jurisdictional challenge.
So promptness is key. What if no return has been filed at all? Does the timeline for challenging jurisdiction differ then?
Yes, it does. If no return has been filed, the question of jurisdiction must be raised within the time allowed by a notice under Section 142(1) or Section 148 for income escaping assessment for filing the return, or by a notice under the first proviso to Section 144 for best judgment assessment to show cause, whichever is earlier. Essentially, it's tied to the first official communication from the department that seeks a substantive response from you.
And what if it's a search or requisition case, which often involves very immediate and serious actions? Do those have an even tighter deadline for jurisdictional challenges?
They do. In cases where a search is initiated under Section 132 or books and assets are requisitioned under Section 132A, the time limit to question jurisdiction is within 1 month from the date of service of a notice under Section 153A1 or Section 153C2. These sections were particularly applicable before April 1st, 2021, or the completion of the assessment, whichever is earlier.
1 month again. Very tight.
It's a very tight window, yeah. It emphasizes prompt and decisive action from the assessee in these high-stakes situations.
And if the assessee does question the jurisdiction, but the AO isn't satisfied with their claim, does the AO just proceed with the assessment anyway? Or is there a procedural safeguard?
There's a vital procedural safeguard. If the assessing officer is not satisfied with the correctness of the assessee's claim regarding jurisdiction, the AO must refer the matter for determination by the higher authorities we just discussed, Principal Director General, Chief Commissioner, etc., before the assessment is actually made.
Okay, so it has to be resolved first.
Exactly. This ensures that jurisdictional issues are resolved at the appropriate level and by the correct authority before the substantive assessment process can legitimately proceed.
Moving on, let's talk about the power to transfer cases under Section 127. In a world of increasingly faceless assessments, this might seem less common, but it's still a crucial power that allows higher authorities to reassign cases. Why is this power important, and who wields it?
This power is indeed critical for administrative efficiency, managing workload, and sometimes for focusing investigations. Principal Director Generals, Director Generals, Principal Chief Commissioners, Chief Commissioners, Principal Commissioners, or Commissioners are empowered to transfer a case from one assessing officer to another, even if it involves concurrent jurisdiction. A key condition for this transfer, wherever possible, is that the assessee must be given a reasonable opportunity of being heard.
Okay.
And the precise reasons for the transfer must be recorded in writing. This ensures that transfers aren't arbitrary and provides a safeguard against misuse.
So, opportunity to be heard is important. But are there exceptions to this? And what happens if the assessing officers involved in the transfer don't fall under the same higher authority? That sounds like it could get complicated.
Yes, there's an important exception to the hearing requirement. If the transfer is between assessing officers whose offices are located within the same city, locality, or place, then it is not necessary to provide the assessee with an opportunity of being heard.
Ah, okay. If it's just down the hall, basically.
Pretty much, yeah. This simplifies transfers for internal administrative convenience without affecting the taxpayer significantly. If, however, the AOs involved are not subordinate to the same higher authority, the transfer requires mutual agreement between their respective higher authorities. If they can't agree, then the CBDT or an authorized authority steps in to make the final decision. This clear chain of command ensures that no case gets stuck in jurisdictional limbo.
That sounds like a lot of coordination to ensure a smooth transition. What about any notices already issued? Do they need to be reissued after a case is transferred?
No, the law clarifies that the transfer of a case can happen at any stage of the proceedings, and it does not necessitate the reissue of any notices that were already issued by the original assessing officer.
Okay, good. Saves time.
Exactly. This prevents unnecessary delays and administrative burdens, maintaining the continuity of the proceedings. It's also important to understand that for both Sections 120 and 127, the term case is broadly defined to mean all proceedings for any year, whether pending, completed, or even those that may be commenced in the future for that same year. This comprehensive definition ensures that transfers cover the entire tax history for that period.
Speaking of continuity, Section 129 addresses the change of income tax authority, or what happens when one officer leaves and another takes over a pending case. What's the rule here, and what rights does the taxpayer have when a new person steps in?
Well, when an income tax authority ceases to exercise jurisdiction and is succeeded by another officer, the succeeding authority can generally continue the proceedings from the precise stage where the predecessor left off.
Makes sense.
This is a practical measure to prevent cases from having to start from scratch, which would be highly inefficient. However, a crucial right is given to the assessee. They can demand a rehearing of the previous proceedings or even a reopening of parts of those proceedings before any final assessment order is passed against them.
Oh, they can ask for a do-over, essentially?
In a way, yes. It protects the assessee's fundamental right to present their case fully and fairly to the new authority, ensuring due process is maintained regardless of personnel changes.
Right. This is a truly significant development, reflecting the modern shift towards digital and transparent tax administration. Section 130 introduces the faceless jurisdiction of income tax authorities. How does this fundamentally change how the department operates, and what are its core goals?
Yeah, if we connect this to the bigger picture, faceless regimes represent a real paradigm shift. They aim to fundamentally reduce human intervention and discretion, which in turn aims for greater consistency, speed, and fairness. Section 130 empowers the central government to notify schemes for faceless jurisdiction, specifically to enhance efficiency, transparency, and accountability in tax administration.
Okay.
The primary purposes are clear. First, eliminating the human interface between the income tax authority and the assessee where feasible. Second, optimizing resource utilization through economies of scale and functional specialization. And third, introducing a team-based exercise of powers with dynamic jurisdiction.
Dynamic jurisdiction, what does that mean exactly?
It means cases can be handled by officers located anywhere in the country, allocated automatically by a system, fostering genuine impartiality and reducing opportunities for bias or, well, corruption.
So it's about making the process less about who you know or where you're located and more about what the law says, pure and simple. And what kind of schemes have already been implemented under this provision that taxpayers should be aware of?
Precisely. This shift significantly reduces opportunities for undue influence. Under notification number 152022, several schemes have already been rolled out to implement this faceless approach across various functions. These include the prominent faceless assessment scheme under Section 144B, which governs how assessments are carried out, the faceless appeal scheme for handling appeals, and the faceless penalty scheme.
Okay.
Furthermore, the e-verification scheme applies to various information gathering powers like Sections 133, calling for information, 133B, collecting certain information, 133C, calling for information by a prescribed authority, 134, inspecting company registers, and 135, powers of higher authorities for inquiries. There's also the e-advance ruling scheme. All these initiatives collectively underscore a resolute move towards a paperless, human interface-free tax administration, aiming for a more objective and efficient system.
Right. The future is digital, even in tax.
Seems that way. Now let's get into the nitty-gritty. The actual powers of income tax authorities. This is where the rubber meets the road, especially for compliance and enforcement. Sections 131 to 136 detail these powers, starting with those related to discovery and evidence, which are quite broad.
So Section 131 gives income tax authorities powers similar to a civil court. What exactly does that entail, and who possesses these broad powers?
Yes, Section 131 grants powers akin to those of a civil court under the Code of Civil Procedure, 1908, to a range of income tax authorities. This includes the assessing officer, joint commissioner appeals, principal chief commissioner, principal commissioner, and the dispute resolution panel. These powers cover crucial matters such as discovery and inspection of documents, enforcing the attendance of any person, including banking officers, and examining them on oath.
On oath. So, like testifying.
Exactly. Compelling the production of books of account and documents, and issuing commissions to gather evidence. This means they act in a quasi-judicial capacity, requiring adherence to established judicial principles, making proceedings more formal and legally binding.
That's quite a bit of power. But what if there isn't an active proceeding against someone, like an assessment or an appeal?
Yeah?
Can they still use these powers to just inquire or investigate? Here's where it gets truly interesting, because this is a common point of confusion.
This is indeed a crucial expansion of their powers, and it allows for proactive information gathering. Sections 131(1)(a) and 131(2) specifically allow certain authorities to exercise these civil court-like powers, even if no formal proceeding is pending. Yes. For instance, if a principal director general or their subordinates like joint directors or assistant directors have reason to suspect that income has been or is likely to be concealed, they can use these powers for inquiry or investigation. This allows them to proactively gather intelligence. Additionally, authorities not below the rank of assistant commissioner, as specifically notified by the CBDT, can use these powers for inquiries related to international information exchange agreements under Sections 90 or 90A, again, irrespective of a pending proceeding.
So they don't necessarily have to wait for a formal assessment to start digging. They can use these powers for intelligence gathering. That's a powerful tool. And once they get their hands on documents, can they just keep them indefinitely?
What are the specific rules around impounding and retaining books of account under this section?
Section 131(3) grants the general power to impound and retain books of account or other documents for a period they deem fit for inquiry. However, for assessing officers, assistant directors, or deputy directors, there are specific critical restrictions.
Okay, what are they? They must record their reasons for impounding the documents, and they cannot retain them for more than 15 days, excluding holidays, without first obtaining prior approval from higher authorities, like a principal chief commissioner, principal director general, principal commissioner, principal director, or director.
15 days without approval. Got it.
Right. This ensures accountability and prevents indefinite retention without a clear justification and a higher level sign-off.
Okay. Now, this is perhaps the most talked about power, the search and seizure, often known informally as a raid. It's a big deal, involving significant intrusion, and the law specifies it in great detail under Section 132. This is often where things get intense, and for your exam, understanding the intricate legal framework is paramount.
Indeed. Section 132 confers wide-ranging powers for search and seizure operations, but it's vital to remember they are not arbitrary. The authority to issue a search authorization typically rests with high-ranking officials, your PDGs, DGs, PCCITs, CCITs, PCITs, or CITs. The CBDT can also empower additional directors, additional commissioners, joint directors, or joint commissioners to issue such authorizations. These authorizing officers then empower subordinates, like a joint director, ADL commissioner, ACIT, or ITO, to actually conduct the search on the ground.
So it's senior officers who authorize and then junior officers who carry out the actual search. But what's the fundamental trigger for such an intrusive action I've heard reason to believe is a critical prerequisite? What does that mean in practice?
That's absolutely correct, and it's a non-negotiable prerequisite, a critical legal bulwark. The authorizing officer must have specific information in their possession and a genuine reason to believe that one of three conditions exists. First, that a summons under 131(1) or a notice under 142(1) was issued to produce documents, but the person failed or omitted to produce them. Second, that the person will not or would not produce relevant books or documents if summoned or noticed. And third, and most commonly, that the person is in possession of undisclosed money, bullion, jewelry, or other valuable articles or things.
Undisclosed income, basically.
Exactly. This reason to believe must be recorded by the authorizing officer, but it is explicitly stated that it shall not be disclosed to any person, authority, or even the appellate tribunal. This maintains the confidentiality of the intelligence while ensuring a legal basis for the search.
That's a fascinating detail. The reason must be recorded but kept secret from the public. So once a search is authorized, what are the actual powers of the officer conducting the search? What can they physically do on the premises?
The powers of the authorized officer are extensive and direct. They can enter and search any building, place, vehicle, vessel, or aircraft where books, documents, or valuables are suspected to be kept.
Any place. Wow.
Any place where they have reason to believe such items are. If keys are unavailable, they can break open locks of doors, boxes, safes, or any other receptacle. They can also search any person entering, leaving, or present in the premises if they are suspected of secreting items. In the digital age, they can require any person in control of electronic records to provide facilities for inspection.
And what about seizing actual assets? Can they just take anything they find, or are there limitations?
There are important limitations which are frequently tested. They can seize books, documents, money, bullion, jewelry, and other valuable articles or things found during the search. However, a crucial exception exists. Stock in trade, such as bullion, jewelry, or other valuable articles meant for business, cannot be physically seized.
Oh, so business stock is safe from seizure itself.
Safe from physical seizure, yes. In such cases, the authorized officer can only make an inventory or a detailed note of these items. They can also place identification marks on books and documents and make copies or extracts from them. A comprehensive inventory of all seized assets must also be made, documenting everything taken into custody.
This raises an important question. Why such detailed conditions for search and seizure? It's about balancing the revenue's critical need to uncover concealed income with the individual's fundamental right to privacy and due process. The law aims to prevent arbitrary action. But what if information during a search points to another location, maybe even outside the authorizing officer's usual jurisdiction?
That's covered by two important provisions demonstrating the law's adaptability. The first proviso to Section 132(1) allows a principal chief commissioner or principal commissioner or commissioner to authorize a search outside their ordinary territorial jurisdiction if they believe any delay in obtaining authorization from the naturally jurisdictional authority would be genuinely prejudicial to revenue interests.
So for speed, basically.
Exactly. This is for urgent situations where immediate action is paramount. For instance, if a commissioner in Mumbai has jurisdiction over a company's main office, but discovers that crucial undisclosed assets are in a building in Delhi, outside their personal jurisdiction, and delay would allow removal, they can authorize the search in Delhi directly.
So they can bypass immediate jurisdictional lines for the sake of urgency. And what about places that weren't initially specified in the search warrant? Can they expand the search on the fly?
Section 132(1)(a) allows for this. If, during a search, information surfaces that suggests undisclosed items are kept in a place not specified in the original warrant, the higher authority can immediately authorize a search of that new, previously unspecified location. Again, the reason to suspect for this new location must be recorded but remains confidential. This ensures that new leads discovered during an ongoing search can be immediately pursued to prevent evidence from being moved or destroyed.
Can the authorized officer call for help from other government agencies or even private individuals during a search if they need assistance?
Yes, Section 132.2 specifically permits the authorized officer to requisition the services of police officers, other central government officers, or even persons or entities approved by a principal chief commissioner or director general. It becomes the legal duty of these individuals or entities to comply with such a requisition, providing critical assistance for the successful and safe execution of the search operation.
Now, what if it's impossible to physically seize an asset, perhaps because it's too big, too heavy, or even dangerous to move? Does the department just have to leave it there?
That's where the concept of deemed seizure comes in, under the second proviso to Section 132.1. If physical possession and removal of a valuable article or thing is not possible or practical due to its sheer volume, weight, physical characteristics, or inherently dangerous nature. Imagine a massive immovable vault or hazardous materials. The authorized officer can serve an order on the owner or possessor, prohibiting them from removing or dealing with it without explicit permission. This action is then deemed to be a seizure, providing the department with legal control without physical custody. Crucially, remember, this does not apply to stock and trade.
And what's the precise difference between that deemed seizure and a restraint order under Section 132.3? This seems like a subtle but very important distinction for application-based questions.
This is an excellent point and a common area of confusion. A restraint order under Section 132.3 is used when seizure is not practicable for reasons other than volume, weight, or dangerous nature. For example, if during a search, gold is found, and the assessee immediately provides convincing documentation proving it's not their undisclosed income, but belongs to someone else with proper legal backing. In such a scenario, the officer cannot seize it due to lack of a valid reason to believe that this particular asset constitutes undisclosed income of the searched person.
Right.
However, to prevent its disposal or removal during further inquiry into its actual ownership or source, a temporary restraint order can be issued. The crucial difference is that a restraint order is not deemed to be a seizure. It simply prohibits dealing with the asset without permission for a specified period.
And the duration is different, too.
Yes, its validity is also much shorter, a maximum of 60 days from the date of the order as per Section 132.8a.
So a restraint order is more about temporary control and inquiry, while deemed seizure is like a full seizure without physical removal. That's a vital nuance. What about statements made during a search? Are they admissible as evidence, and how are they recorded?
Yes, very much so. Section 132.4 empowers the authorized officer to examine on oath any person found in possession or control of books or assets. This means they can administer an oath and record sworn statements.
Okay.
Any statements made by such a person during this examination can then be used as evidence in any proceeding under the Act. This is a powerful tool for obtaining admissions or clarifications directly during the search operation itself.
And there are also rebuttable presumptions under Section 132.4a. What are these, and how do they benefit the department during a search? For the taxpayer, what's the implication?
These presumptions simplify the initial evidentiary burden for the department, but they are rebuttable, meaning the assessee can present evidence to prove otherwise.
Okay, so you can fight them.
You can. During a search, it is presumed, until proven otherwise by the assessee with evidence, that first, any books, documents, or assets found belong to the person in possession. Second, the contents of those books or documents are true. Third, any signatures or handwriting found on documents are those of the person in possession. And fourth, any stamped, executed, or attested documents were duly and properly done by the purported person. These presumptions provide a strong starting point for the investigation, effectively placing the initial onus on the assessee to provide counter-evidence if they dispute the facts. It underscores the serious nature of items found during a search.
So the burden is effectively on the taxpayer to prove otherwise, which can be challenging in the heat of a search. How long can the department hold on to seized books and documents after a search? And what if the taxpayer objects?
Section 132.8 stipulates that seized books or documents cannot be retained for more than 1 month from the end of the quarter in which the relevant assessment order, under Sections 143, 144, 147, or 153A, is made.
1 month after the quarter end of the assessment order.
Okay.
However, retention can be extended if reasons are recorded in writing and prior approval from higher authorities like the Principal Chief Commissioner or Director General is obtained. Even with approval, the maximum extended retention period cannot exceed 30 days after all assessment proceedings for the relevant years are fully completed.
Right.
If a person objects to this extended retention, Section 132.10 allows them to apply directly to the CBDT for the return of their documents. The CBDT will then hear their application and pass a binding order.
And can the person whose documents were seized get copies for their own records, perhaps to prepare their defense or furnish information? Yes. Section 132.9 ensures this right. The person from whom books or documents are seized is explicitly permitted to make copies or extracts from them in the presence of the authorized officer or someone empowered by them, at a time and place mutually appointed by the officer. This ensures the taxpayer retains access to their financial records, which is crucial for their own compliance and any subsequent proceedings.
What if the officer who seized the documents doesn't have the primary jurisdiction over the person or the case they belong to? Does that complicate matters?
This is an important procedural point under Section 132.9. If the authorized officer conducting the search does not have the ultimate jurisdiction over the person to whom the seized items belong, they must hand over those books, documents, money, bullion, jewelry, or other valuable articles to the jurisdictional assessing officer within a strict period of 60 days from the date on which the last of the authorizations for search was executed.
60 days to hand it over.
Right. The last of authorization for search is precisely defined as the conclusion of the search as recorded in the last official penchnama. Once handed over, the jurisdictional AO then takes full charge and exercises all the subsequent powers related to retention and providing copies.
Beyond seizing assets, authorities also have the power of provisional attachment of property under Section 132.9b and 9c. What's the purpose of this and how does it work, especially in search cases?
This power is a crucial safeguard for revenue. Its primary purpose is to protect the interest of the revenue and ensure that potential tax liabilities, penalties, and interest can be recovered. It prevents the assessee from disposing of assets before a final assessment is made.
Okay, so it freezes the assets.
Essentially, yes. This power can be exercised either during a search itself or within 60 days from the date the last search authorization was executed. If the authorized officer is satisfied, for reasons to be recorded in writing that it's necessary, they can provisionally attach any property belonging to the assessee. A vital condition here is that they must obtain prior approval from a high-ranking officer in the investigation wing only, such as a principal director general, principal director, or director. This underscores its use as an enforcement tool during active investigations.
So it's about making sure assets don't disappear while the assessment process is ongoing. How long does such a provisional attachment remain valid? Is it indefinite?
No, it's not indefinite. Section 132.9 specifies that every provisional attachment ceases to have effect after the expiry of a period of 6 months from the date of the order.
6 months.
Yes. This ensures it's a temporary measure designed to secure revenue during the assessment phase, not an indefinite confiscation. Additionally, Section 132.9d empowers the authorized officer to refer the valuation of any property, including assets that might be attached, to a valuation officer or an approved valuer within 60 days of the search execution, with the report due within another 60 days. This ensures proper and objective valuation of seized or attached assets.
And finally, when it comes to search and seizure, how do the general criminal laws apply? And what about the specific penalties for undisclosed income found during a search? This is a strong incentive for cooperation.
Section 132.13 clarifies that the provisions of the Criminal Procedure Code, CRPC, relating to searches and seizures apply, as far as possible, to searches and seizures carried out under the Income Tax Act. This provides a clear procedural framework. Regarding penalties, Section 271 AEB-1A is specifically applicable for searches initiated on or after December 15, 2016. The penalty rates depend heavily on the assessee's cooperation and transparency.
Okay, how so?
If the assessee admits undisclosed income during the search statement under Section 132.4, explains its nature and source, pays the tax and interest on it, and furnishes the return by the specified date, the penalty is a lower 30% of the undisclosed income.
30% if you cooperate fully.
Exactly. However, in all other cases, meaning if these conditions are not met or if the income is not admitted, the penalty jumps significantly to 60% of the undisclosed income.
60%. Wow, that's steep.
It is. It's also important to note that no penalty under Section 270A, under reporting misreporting, or Section 271, is levied for the specific undisclosed income, avoiding double penalty. This provision is a powerful tool to encourage self-disclosure and prompt payment during a search.
That's a strong incentive for taxpayers to be transparent during a search. And what about relevant case laws for search and seizure that students should know, which really illustrate these principles?
There are two illustrative cases that clarify key aspects. In S.R. Batley-Boy v. IT Department, the principle established related to the seizure of digital devices like laptops. The court clarified that the department is only liable to provide information related to the specific client under investigation, not data belonging to other clients or third parties found on the device.
Protects other clients' privacy.
Right. The Ajit Jain case addressed the crucial reason to believe trigger for a search. It held that mere possession of cash by a person, perhaps discovered by another agency like the CBI, is not sufficient information to trigger a valid search and seizure under Section 132. There must be a specific reason to believe that the cash constitutes undisclosed income of that person. This case stresses against the misuse of power and emphasizes the absolute necessity for concrete, specific intelligence before initiating an intrusive search.
Very important points. Now, what if the books or assets are already with another authority, perhaps seized under a different law, say, by the police or customs? Can the income tax departments still get them? That's where Section 132A, power to requisition books of account, comes in.
This is a distinct power from direct search and seizure, offering a mechanism for interagency cooperation. Section 132A allows income tax authorities to formally request books, documents, or assets that have already been taken into custody by other authorities under other laws, for example, police, customs, ED, etc. The authorizing officer, again, high-ranking officials like a PDG or CCIT, must have reason to believe that the person failed to produce these documents despite summons, or that they won't produce them once returned by the other authority, or that the assets represent undisclosed income. This reason to believe must be recorded, but, as with search, is not disclosed. It's like a legal handoff of evidence.
So it's like a formal request for evidence that's already in someone else's possession. What happens once that request is made? Does the other authority have to hand them over immediately, or can they hold on to them?
Section 132A2 mandates that the other officer or authority must deliver the items to the requisitioning income tax officer either forthwith, immediately, or when they are no longer necessary for their own custody or proceedings. Crucially, once these items are delivered, Section 132A3 states that they are deemed to be seized under Section 132.1.
Ah, so they become treated just like search assets.
Exactly. This means that all the subsequent provisions related to search and seizure, such as the rebuttable presumptions, retention periods, and the application of assets, sections 132.4a to 132.14 and 132.bb, automatically apply to these requisition items as well, ensuring consistent legal treatment.
Okay, so they've seized assets or requisitioned them. What happens to them then? How are they used by the department, and how can you, the taxpayer, get them back? This is all covered by Section 132B, the application of seized or requisitioned assets. It's a very specific framework designed to recover dues while also ensuring that the taxpayer isn't indefinitely deprived of their property.
Indeed. Section 132B1 outlines precisely how these assets can be utilized. They can be used to recover any existing liability under various direct tax laws, income tax, wealth tax, expenditure tax, gift tax, interest tax, and notably, from October 1st, 2024, the Black Money Act 2015 is also included.
Black Money Act too, okay.
However, a crucial exclusion to remember for your exam is advance tax. It cannot be recovered from seized assets as an existing liability.
Wait, no advance tax.
The assets can also be used to settle liability determined upon completion of the assessment or reassessment following the search, including any penalty or interest. Lastly, any liability arising from an application before the Dispute Resolution Committee, which replaced the Settlement Commission, can also be adjusted from these assets.
So it's for actual assessed liabilities, not just an estimated future tax bill.
Yeah.
And in what sequence are these assets applied? Is it cash first, then other assets, or does the department have discretion?
Yes. The sequence is clear under Sections 132B1, 2, and 3. If the assets include money, the money is applied first to discharge the liabilities. That's common sense. Use the liquid asset first.
Right.
If liabilities still remain after applying the money, other assets are then deemed to be under distraint and can be sold in a manner laid down in the third schedule of the Act. Any remaining assets or proceeds after all liabilities are discharged must be forthwith paid back to the person from whom they were seized. This is a crucial safeguard for the taxpayer's rights.
That's good to know. There's a clear process for releasing the balance. Can the assessee proactively apply to get their seized assets released even before the assessment is fully complete, perhaps if they can explain the source of the assets?
Yes. There's a specific proviso to Section 132B1 for this. An assessee can make an application to the assessing officer within 30 days from the end of the month of seizure for the release of their assets.
30 days from month end.
Right. This is conditional upon the assessee fully disclosing the nature and source of acquisition of the asset to the AO's satisfaction. If the AO is satisfied, they can recover the existing liability and release the remaining portion of the asset, but only with the prior approval of the Principal Chief Commissioner or Principal Commissioner or Commissioner. This release must happen within 120 days from the date on which the last of the authorizations for search or requisition was executed. It offers a limited window for early release based on transparency.
And what about interest on any amount that's eventually refunded? Does the department have to pay interest if they hold on to assets for too long, essentially compensating the taxpayer for the delay?
Yes, Section 132B4 ensures that. The central government pays simple interest at the rate of 0.5% per month or part of a month on the amount by which the seized money, less any amounts released, and proceeds from asset sales exceed the actual liabilities determined.
0.5% per month.
Yes. This interest starts accruing from the day immediately following the expiry of 120 days from the date of search or requisition execution and continues up to the date of assessment completion. It's a key mechanism to encourage timely completion of assessments and provide a small compensation to the taxpayer for the period their assets were held.
That's a nice touch, ensuring the department acts swiftly. Any notable case laws on the application of seized assets that students should remember?
A key case here is Hemant Kumar Sindhi. In this case, the assessee had applied to the income tax authority to sell seized gold and adjust the proceeds against his future tax liability, anticipating tax, penalty, and interest on undisclosed income.
Trying to pay in advance, essentially.
Kind of. The court's decision was clear. This request was denied. The principle established was that only existing liabilities can be adjusted from seized assets. Future liabilities, which are still pending assessment and have not yet been determined, cannot be adjusted proactively from seized funds. This reinforces the idea that seized assets are for immediate or determined liabilities, not speculative future ones.
So it's a very specific framework designed to recover dues while also ensuring that the taxpayer isn't indefinitely deprived of their assets. Moving on, let's talk about the power to call for information under Section 133. This seems like a broad power that tax authorities would use regularly for intelligence and assessment.
It is indeed a widely used and fundamental power, absolutely critical for information gathering for inquiry or ongoing proceedings. Section 133 empowers various authorities, including the AO, DCITA, CITA, to require various persons to furnish specific information. It's the department's primary tool for casting a wide net for relevant data.
What kind of information can they ask for under this section? Can you give us some practical examples of what might be requested?
Certainly. They can require a firm to provide names and addresses of its partners and their shares, or an HUF to provide names and addresses of its manager and family members. A trustee, guardian, or agent might be asked for the names of persons for whom they act. An assessee can be compelled to furnish a statement of payments exceeding €1,000 made in any previous year, things like rent, interest, commission, royalty, brokerage, along with particulars. Brokers, agents, or dealers on stock or commodity exchanges can be asked for details of persons for whom assets were purchased or sold for their clients.
Those are pretty specific, covering various entities. What about banks? Can they compel a bank to reveal a customer's account information, which is usually considered highly confidential?
Yes, and this is a particularly significant aspect with important safeguards. Authorities can require any person, including a banking company or any officer thereof, to furnish any information or statements of accounts and affairs that are useful for any inquiry or proceeding under the Act. However, and this is a crucial condition that's important for exams, if no formal proceeding is pending against a specific assessee and it's merely a general inquiry, then information from banks can only be requested by authorities not below the rank of Principal Director or Principal Commissioner with prior approval of their respective Principal Director or Principal Commissioner. Joint directors, deputy directors, and assistant directors are also empowered to make such requests.
So, higher approval needed for bank info if there's no case open yet.
Exactly. This tiered approval prevents phishing expeditions into sensitive financial data.
That distinction between a pending proceeding and just an inquiry is key, and the requirement for higher approval makes sense to prevent overreach into sensitive bank data. Is there case law that specifically highlights this?
Yes, the Cathy Service Cooperative Bank versus CIT case precisely emphasized the need for prior approval from higher authorities when seeking information from banks in cases where no assessment proceedings are pending. This case law reinforces the importance of this safeguard.
Got it.
And if a person fails to furnish information as required under Section 133 without reasonable cause, a penalty of $500 per day can be levied for the default.
Okay, moving from a full-blown raid to something a bit less intrusive but still powerful, the power of survey under Section 123A. It's often misunderstood as a raid, so let's clarify its true scope. It's more about on-the-spot verification than a full-scale search, right?
That's an excellent way to put it. Section 133A covers several distinct types of surveys, each with different powers and limitations. The most common is the general survey under Section 133A1. This allows any income tax authority from a TRO up to a PCIT or DIT to enter premises, but only with prior approval from a very high-ranking authority like a PCCIT, CCIT, PDG, or DG.
High-level approval needed even for a survey.
Yes, this ensures a significant level of oversight for these operations.
So who can enter, and what specific kind of places can they enter for a general survey?
They can enter any place where a business, profession, or even a charitable activity is carried on. This includes not just the primary business place, but also any other place, like a home, if the person explicitly states that books of account, documents, cash, or stock related to their business are kept there. The objective is to inspect books, check cash stock valuables, and require relevant information.
And crucially, when can they enter? Are there specific hours for a general survey, which can be a key point for practical questions?
Yes, the timing is strictly regulated, and this distinction is vital for your exam. For premises where a business or profession is carried on, they can only enter during business hours.
Okay, standard business hours.
However, for any other place, like a residence where books are kept but no business is conducted, they can only enter after sunrise and before sunset. This time distinction is a common area for misinterpretation and testing.
Sunrise to sunset for non-business places. Okay, that's clear. So, they're in. What can they actually do inside the premises during a general survey? Can they seize things like in a raid?
During a general survey, they can inspect books and documents, place identification marks on them, and take extracts or copies. They can also check and verify cash, stock, and other valuables and make a detailed inventory of these items. Critically, and this is a major difference from a search, they cannot remove cash, stock, or other valuables from the premises.
Cannot remove cash or stock, that's key.
Very key. However, they can impound and retain books of account and documents, but only after recording specific reasons and not for more than 15 days, excluding holidays, without prior approval from a high-ranking authority like a PCCIT or PDG. They can also record statements from persons present, but these statements are not on oath.
Not enough. Okay, less weight legally.
Generally, yes. They are considered less formal and not directly usable as evidence in the same way as Section 132 statements recorded on oath.
That's a very important distinction. Statements not on oath. What about surveys specifically focused on TDS or TCS compliance? Do they have the same powers as a general survey, or are they more limited?
No, the TDS-TCS survey under Section 133A2A has a much more limited and precise scope. Its sole objective is to verify compliance with tax deducted at source, TDS, or tax collected at source, TCS provisions.
Just TDS, TCS.
Right. Authorities can only enter the place of business or profession, not other places like homes, and they can only enter after sunrise and before sunset, regardless of specific business hours. Their powers are strictly limited to inspecting books and documents related to TDS-TCS and requiring relevant information. Crucially, they cannot impound books or documents, nor can they make notes or records or inventories of cash, stock, or valuables. Their focus is solely on compliance verification for these specific provisions, making it far less intrusive.
So a TDS-TCS survey is far less intrusive than a general survey, and definitely less so than a search, which makes sense given its specific purpose. What about a survey related to lavish expenditures like a wedding or a large event? How does that work?
Section 133A5 allows for a survey specifically relating to expenses incurred in any function, ceremony, or event if the income tax authority believes the nature and scale of the expenditure warrant inquiry.
So after the party's over.
Exactly. This can only happen after the function or event has concluded, not during. The authority can then require information from the assessee or anyone likely to have knowledge about the expenditure incurred, and they can record statements. In this specific context, unlike the general survey, the statements recorded can be used as evidence.
Okay, statements or evidence in this specific survey type.
Correct.
And if someone refuses to cooperate during a survey, what recourse does the authority have? Can they force compliance?
Section 133A6 clarifies that if a person refuses or evades compliance during a survey, the income tax authority can then exercise all the powers available under Section 131 to enforce compliance. This means they can issue summons, compel production of documents, and examine persons on oath to ensure cooperation. And just like the general survey, any action under Section 133A requires prior approval of the Principal Director General, Principal Chief Commissioner, or Chief Commissioner.
Approval still needed. Okay.
This whole discussion highlights the continuum of power, from the most intrusive search and seizure down to the least intrusive, which is mere information collection. Each power has distinct triggers, limitations, and consequences, which is absolutely essential to differentiate for your exams. Now, let's look at Section 133B, power to collect certain information, which is even more limited than a survey.
So Section 133B is truly just about collecting information with no impounding or retention or anything as serious as a survey or search.
Exactly. This is indeed the least intrusive power among the information-gathering tools. Under Section 133B, a joint commissioner, assistant director, deputy director, assessing officer, or an authorized income tax inspector can enter any place where a business or profession is carried on, but not charitable activities or other places like homes.
Only business premises again.
Yes, and only during business hours. Their sole power is to require information as prescribed by rules, typically basic identifying or transactional data.
So what sets it apart from a survey, other than the limited scope of action? Are there any key procedural differences?
The key differences are critical for differentiation. Unlike surveys or searches, under Section 133B, the authorities cannot physically touch, remove, impound, or retain any books of account, documents, cash, stock, or any other valuable article or thing. This power is purely for obtaining specified information.
No touching, no taking, just asking.
Pretty much. Another significant distinction for exam purposes is that no prior approval from higher authorities is required for a Section 133B entry, unlike a survey.
No approval needed for 133B.
Okay. If a person fails to comply with a request under Section 133B, they are liable to a modest fine of up to $1,000. This highlights its non-intrusive information-gathering nature, often used for data verification rather than investigation.
That really makes the distinctions crystal clear. So there's a clear ladder of intensity for these powers, from mere information collection to full-blown search and seizure, each with its own precise rules and triggers. Before we wrap up the powers, are there any other minor but still relevant powers worth a brief mention for exam purposes?
Yes, briefly. Section 133C grants the power to call for information by a prospective income tax authority for verification purposes, including through a faceless scheme. This is a broad digital first information request tool. Section 134 allows authorities to inspect registers of companies, such as those detailing members, debenture holders, or mortgagees, and to take copies from them. This provides transparency into corporate structures. Finally, Section 135 confirms that Principal Director General, Principal Director, Director PCCI, TCCI, TCI, TCIT, and JCIT are competent to make inquiries under the Act and possess all the powers of an assessing officer for that purpose, ensuring senior officers can conduct investigations themselves when needed.
And finally, to cap off our understanding of these powers, Section 136 states that proceedings before income tax authorities are considered judicial proceedings. What does that truly imply for you, the taxpayer, and the seriousness of these interactions?
This is a critical legal designation that elevates the seriousness and legal sanctity of proceedings before an income tax authority. It means any such proceeding is deemed to be a judicial proceeding within the meaning of Sections 193 and 228 of the Indian Penal Code.
So perjury laws apply.
Exactly. In plain terms, this means that if you give false evidence or make a false statement on oath to a tax authority, it's considered perjury, just like lying in a court of law. And if you intentionally insult or interrupt a tax official sitting in a judicial proceeding, it's akin to contempt of court. It also means that for the purposes of Section 195 of the Criminal Procedure Code, which deals with prosecution for contempt of lawful authority of public servants, the income tax authority is deemed to be a civil court.
Okay.
However, they are not considered a civil court for the purposes of Chapter 26 of the Criminal Procedure Code, which covers provisions related to certain offenses. This underscores that interactions with these officials carry the weight and formality of court proceedings.
Woo! That was a deep dive indeed. I've just navigated the entire intricate landscape of income tax authorities, from the hierarchy that governs them to the specific powers they wield, and even how they handle the assets they seize and how their proceedings are viewed legally. You're now equipped with a clear, detailed, and truly exam-ready understanding of this complex yet fundamental area of tax law.
Precisely. Remember, understanding the nuances, like the crucial difference between a deemed seizure and a restraint order, or the varying entry times and powers for different types of surveys, is absolutely key for those application-based questions on your exam.
Right.
The goal here was to help you build a robust mental framework, connecting each section not just to its definition, but to its real-world purpose and its practical implications for both compliance and enforcement. Always consider the why behind these provisions, as it often clarifies the what and how.
So after this comprehensive session, what stands out to you? How does this deeper understanding of the tax authority's powers change your perspective on compliance, or even your approach to financial planning? It's not just about passing an exam, it's about being profoundly well-informed in a world that increasingly demands it. Keep exploring, keep learning, and we'll see you on the next deep dive.